On paper, this strategy showed an annual return of 18% with a maximum drawdown under 8%. The rules were simple, the code was clean, and the backtest covered 3 years of tick data on the Euro-US dollar. 2 weeks after pushing it to a live execution environment, the equity curve went completely flat, losing 3.2% of the account in small, persistent friction costs. In this video, you will learn why combining exponential moving averages with the average directional index creates hidden execution lag, and why I paused this bot despite clean backtest results. No bull trading. I am not selling you a strategy, a course, or a signal group. I have spent 6 years building automated strategies across stocks, crypto, and Forex, currently running algorithms in Python via MetaTrader 5. This video is for retail traders and developers who are tired of internet curve fitting and want to understand how technical indicators actually behave when real market execution enters the equation. Let us start with the core architecture of the strategy. Trend-following algorithms face one central challenge, which is separating genuine market trends from sideways noise. To solve this, the baseline signal relies on a classic dual moving average crossover. We use a 20-period exponential moving average as the fast line and a 50-period exponential moving average as the slow line. A simple moving average crossover generates dozens of false signals when price consolidates in a tight range. Every false cross results in buying at the high of a range and selling at the low. To filter out those bad trades, we add the average directional index, or ADX, set to 14 periods. The rule is straightforward. The bot only takes an EMA crossover trade if the ADX value is strictly greater than 25. The logic seems sound. A rising ADX above 25 indicates that the market is in a strong trending state, while an ADX below 25 signals a weak or choppy market where moving average crosses should be ignored. In Python, the execution block looks concise. If the fast EMA crosses above the slow EMA and the 14-period ADX is above 25, send a buy order with a 2-to-1 reward-to-risk ratio based on the average true range. Running this logic through vectorist backtesting software over 5,000 historical bars produces an appealing performance summary. The profit factor sits at 1.65, with a win rate of 42% and large winning trades carrying the performance. The problem appears the moment this logic is translated from vectorist historical data into a live tick-by-tick execution stream. The first hidden failure point is the structural mathematical lag of the ADX indicator itself. ADX does not measure direction, it measures the strength of movement calculated using smooth directional movement indices over 14 bars. Because ADX relies on double smoothing, by the time the indicator value actually crosses above 25, the price move has frequently already completed its initial expansion phase. The bot enters the market at the exact price point where short-term momentum exhausts itself. Instead of buying the beginning of a trend, the ADX filter forces the algorithm to buy the late stage of an impulse move. The second structural breakdown occurs during transitional regimes, when price moves from a trend into a range. In this state, ADX frequently fluctuates between 24 and 26 across multiple consecutive candles. As ADX flickers across the 25 threshold, a single fast EMA cross can trigger multiple valid entry signals in rapid succession, flipping position state back and forth while price sits completely still. Each execution incurs a real-world transaction cost. Half a pip of spread, plus execution slippage, plus round-turn commissions means that 10 rapid false entries in a sideways market wipe out the gains of an entire 3-day trend trade. To recover the edge, the first natural engineering impulse is to tweak the parameters. We tried raising the ADX threshold from 25 to 30 to ensure only extremely strong trends were traded. Raising the threshold reduced false trades during chop, but it introduced a new issue. The algorithm missed over 60% of valid, profitable trends because the ADX line failed to reach 30 until the trend was over. We then added an average true range filter to check that current candle volatility was expanding before taking an entry signal, attempting to confirm momentum without relying solely on ADX. The combination of EMA cross, ADX above 25, and expanding ATR improved trade selection, but trade frequency dropped so dramatically that the strategy generated only 2 trades per week across major forex pairs. That brings us to the core technical reality of indicator-based algorithms. Stacking lagging indicators on top of lagging indicators does not eliminate lag, it compounds it. Here is the honest truth about this system. The EMA cross is a lagging trend signal. The ADX filter is a lagging regime signal. Combining them creates an algorithm that is mathematically incapable of early execution. A trend-following strategy must accept a low win rate and early drawdowns to capture large moves. Attempting to filter out every loss using technical indicator thresholds simply strips away the mathematical edge of trend following entirely. I chose to pause this bot rather than force it live with adjusted parameters. A strategy that requires hyperspecific parameter tuning to look profitable on paper is not a robust strategy, it is a curve-fitted system waiting to break in live market conditions. Let us recap the 3 key technical takeaways from this teardown. First, combining multiple smoothed indicators compounds total execution lag and delays entries until price moves exhaust themselves. Second, threshold flickering near critical values like ADX 25 introduces severe transaction friction costs that backtests without tick-level execution modeling fail to display. Third, adjusting indicator parameters to eliminate bad trades usually destroys trade frequency and curve fits the system to specific historical volatility regimes. If you value straightforward engineering analysis over marketing hype and theoretical backtests, subscribe to the channel and turn on notifications. In the next video, we will break down netting versus hedge account modes in MetaTrader 5, and how a single account setting can silently disable a straddle trading bot without throwing an explicit code error. This video is for educational purposes only and does not constitute financial advice. All trading involves capital risk, and this video uses an AI-generated voice for narration.